Yeah, let's start with the asset map. Hello and welcome to your weekly installment of the GoNoGo Show. My name is Tyler Wood. I am a CMT charter holder, and as always, I am joined by Alex Cole, the Chief of Charts. How you doing, my friend?
Doing well, thank you.
Awesome. This is Alex's last week in the country. You know, as a UK citizen, he has to leave during the Independence Day celebrations, head back to Europe, make sure that his neighbors don't attack him. We're going to wish you well.
It's just the heat. It's just the heat. I can't take the heat.
Yeah, 60 and rainy sounds like a lovely summer in Wales, my friend.
That's right.
I'm getting jealous of you. Today is June 20th, 2024, and as always, we're going to start from the top level. The asset classes on down. We're going to be looking at trends and trying to understand this environment that we are trading in. For any of you who own a TV or subscribe to any financial news media, a lot of our colleagues, fellow CMT charter holders, and others have pointed out some of the conditions that have weakened, some of the things at this top of the markets that we should be paying attention to and being concerned with. Alex, let's start with this cross-asset heat map. Where are the trends? What's happening right now?
Yeah, so you can see that actually on a pure trend basis, we're seeing a lot of go trends. Top panel is the equity markets. We know that we have been at all-time highs. We'll talk about whether or not that seems sustainable as we go through the show. Treasury bond prices in the second panel, also in strong blue go bars as well. Of course, those move inversely to rates, which we'll see as well, I'm sure, as we move along. And then the commodity space seems to have made up its mind. We're seeing over a week now of strong blue bars, as well as the dollar back in a go trend on a pure trend basis as well.
Excellent. So let's dive into a few of these charts. Let's start with the S&P 500. Let's look at a complete GoNoGo chart. So we have a sense of the trend model. That's our top price panel, color-coded bars that are taking that mosaic of technical indicators that we would all use in a responsible process for identifying trend. We're computing all of that in the back end. And so what the algorithm is spitting out is a color-coded bar that gives us the trend direction and strength. So if you're new here, aqua and blue bars are the go trend conditions. We're borrowing that nomenclature from, think of a NASA shuttle launch. Don't think of the Boeing Starliner. But if we were in go trends, all the conditions are on our side for price action to continue higher. No go trends are when the conditions are in favor of downward trajectory. So pink is the weak form, purple is the strong form of a no-go condition. And then at those points of transition, oftentimes, we might see that the market has reached a level of neutrality. So the weight of the evidence in the back end, when all of those component parts are in their neutral territory, we're going to paint amber neutral bars, the go fish conditions. So Alex, S&P 500, where are we at right now? Let's answer those three simple questions.
Well, the trend is a strong go, and we've been seeing this now for a couple of months. People thought we were overextended here, and we just continue to move higher and set higher all-time highs almost daily. We opened up higher today. We've fallen away. So today's bar showing a bit of bearish action. But what I'm going to look for in terms of momentum here is that we've been overbought now for a couple of bars here, just about a week. So when the momentum drops back below our value of 5, we're probably going to see a counter trend correction icon on our chart. So if we see that, we'll know that momentum has waned in the short term. We saw a couple of them here, and that tipped us off to the fact that price may struggle to go higher in the short term. So at the moment, we are overbought on momentum within a strong trend. So we'll look for some kind of cooling off or some kind of pullback should momentum fall out of this overbought level.
Absolutely. Now, here's the lesson that we all have to learn and relearn again. Jesse Livermore has a great quote. He said, "It's a bull market, you know." And the intention behind the quote is that at any time in the as markets climb a wall of worry, as trend followers, we have to be paying attention, being open-minded to the fact that trend conditions can change, sometimes quickly, but that sticking with trends that are working is one of the most important tenets that some of these great fund managers have left to us. So I'm not encouraging anybody to blindly own equities and stay with the market, not considering that there could be more volatility ahead, a change in trend condition, etc. But it is important, and maybe one of the most valuable aspects of technical analysis is to give us a sense of what's happening right now and put it in context. So we can see that this trend has been in continuance for several weeks since we had that corrective area in April, and right now we've got overbought momentum, which is stayed overbought. That's an inherently bullish condition. So we've got the tools at our disposal to signify when those conditions change so that we can react responsibly. Alex, let's move on from the equity index. Let's take a look at some of our macro factors that might be headwinds or tailwinds for this market. Let's take a look at the TNX, the 10-year Treasury yield. Again, a lot of ink being spilt in financial news media about the hawkish tone of Chairman Powell at a time when folks were really expecting easing of the liquidity environment for markets. There's a lot of speculation about when the Fed may or may not cut rates. Let's take a look at what's actually happening to US Treasury rates right now from a trend perspective.
Yeah, we're in a no-go trend, and we're seeing more purple bars. So prices have been moving lower. Rates, I should say, have been moving lower, setting lower highs and lower lows. We just saw momentum get turned away by the zero line. That gave us the red no-go trend continuation icon that we see here. And that, of course, was followed then by another lower low. So the rates environment in a no-go trend, which is usually a good thing for equities. So we'll see how that plays out.
Absolutely. And just to respect our discipline, let's look at this on a couple of time frames. Why don't we pop this out to a weekly bar as well?
Yeah, and when we look at the weekly chart, you can see, if we zoom out a little bit, you can see that we're just nicely in that period, sort of that range of elevated rates, but not racing higher or crashing too much lower, fairly stable. You can see that we're painting at the moment another amber bar. That's that bar of uncertainty. So not enough to tell us that we're in a strong go trend, not enough to tell us that we're going into a no-go trend. And the oscillator back at zero, testing that level from above. So not too much happening on the weekly time frame for rates.
Absolutely. That doesn't mean that periods of low volatility don't often precede areas of higher volatility, but for right now, we're in a neutral trend and moving healthily sideways. All right, let's take a look at that US dollar, Alex. You mentioned that being back in a daily go trend. Talk to us about what's happening for the greenback.
Yeah, this is the weekly chart, and you can see we were so when you have a nice large price panel like this with not too much on it, you can see these levels pop off the chart. And we were really watching when we broke above this prior high now from 2022, and we wanted to see if it would consolidate at and above those levels, and it certainly did. We saw some weakness in the trend as it came down, but found support. This is, of course, the weekly chart, and then the oscillator bounced off zero, told us that there was likely to be trend continuation, as we saw the green circle here, and now we're painting strong blue bars again, and above these sort of pretty consistent higher highs from almost 2 years ago now. So if we go down to the daily chart, you can see that we sort of gapped higher. This was we talked about this earlier in the week, Tyler, you and I think, that this bullish engulfing, if you know your candlestick patterns here, this really big bar on, that was Friday, that really pushed us back towards the highs of this range. And then, of course, we gapped higher. We're painting strong blue bars, and the oscillator's above zero, so confirming the go trend in price for the dollar.
You know, Alex, on the weekly time frame, and now here again on the daily, where you've got your track mouse, we're seeing that polarity principle play out. So on the weekly time frame, those were highs from 2 years ago, which we broke through and then came back to retest. And now we're seeing from a few months ago, what was resistance, once broken through, now becomes support. It's amazing to watch markets behaving in that fractal nature that so many great technicians have spotted before. So we're above that resistance level. It's now acting as support, and the dollar is tracking higher. just for kicks, let's take a look at this on an intraday time frame. I know for all the currency desks out there, they are making moves much faster than weekly and daily time frames. Why don't we bounce this down to a 39-minute bar?
Yeah, so 39-minute bar, lots of gaps happening. So, but on a intraday basis here, we're in a go trend. And just to point out what you were just saying, that same principle applies here. When we saw this gap high at the bottom of that gap, now becoming support. So it was resistance here, and now it becomes support, and now we're back up testing these prior highs on the intraday basis as well.
Absolutely. Awesome look at the US dollar. Let's take a look at gold. Listen to a fascinating podcast from an asset allocator who was talking about the impression that gold is a non-yielding asset and its relationship to fiat currencies in a rising rate environment. What I think for our listeners is most important is where we are at in the context of this trend, having broken out above those prior resistance areas. Talk to us about what's happening for gold right now, Alex.
Well, yeah, the prior resistance areas you're talking about, those come from 10, 11, 12 years ago. We saw the size of that pattern. If you keep it in context, we are definitely well above those levels, but on a daily basis, you can still dive down and see trends playing out that, of course, are slightly different. And we were in a nice go trend. We made a series of higher highs and higher lows. We saw a lot of uncertainty around gold just a couple of weeks ago. You can see all those go fish bars in there telling us that the market wasn't quite sure whether the go trend was to continue or not. And then we slipped below zero first on the oscillator, started to find resistance at that level, and then entered a no-go trend. Most recently, though, today we see we're climbing back out of that no-go, painting another amber bar. So there's definitely a lot of uncertainty, a lot of chop. Oscillators riding the zero line. We're seeing that squeeze build. So this will be interesting to see whether or not we roll over and we go back into a no-go, oscillator stays below zero, or if it breaks above, and perhaps we'll be able to move higher and challenge these prior highs.
Fantastic. And let's take a look at one other key commodity, U.S. oil.
Yeah, so oil's had a really rapid turnaround over the last couple of weeks. We saw it enter the no-go, and it, made new lower low, oscillator generally below zero the whole time. And then it rallied off those lows really quite strongly, and we got back into this congestion area. And this is what we talked about last week. We were sort of in this congestion area. We were wondering what was going to happen as the oscillator started to ride the zero line. Well, it made up its mind fairly quickly, burst out of the small squeeze into positive territory. And of course, we've now re-entered a go trend. And this is the third day of that go trend now for U.S. oil.
Absolutely. Now, as trend followers, it's just a relief rally as we're moving back into the congestion zone. I know for a lot of us, we would love to pick the absolute bottom and the absolute top in all of our trades. But the idea of trend following is to participate in the meat of the move. So a trend being established once we have broken out of that congestion zone, that's what's happening in that price panel. Alex, let's take a look at oil on a weekly basis as well, just to get a little more context of where we're coming from.
Yeah, well, oil's been sort of struggling to make up its mind as well on the weekly. We're seeing quite a lot of uncertainty in these charts at the moment. Just walking you through the last year or so, we were in this falling no-go. We tried to break out of it. We struggled. We saw a lot of uncertainty, lots of amber bars, and we broke back to a go trend, and people thought perhaps that was going to be the one that stuck. And then it ran into resistance, of course, from last October, fell away, and the oscillator fell to the zero line. So right now what we're looking at is this real sort of 2-year range of sort of meandering sideways prices. Now, the weight of the evidence tells us that we are in a go trend and that the oscillator is at the zero line with a go-no-go squeeze building to its max. So if we are able to stay above zero, break out of this squeeze into positive territory, then that might give price the push it needs to try to break above what we now have multiple areas of resistance before we even get back to these earlier highs we see on the chart.
Fantastic. So when we have a view of the overall landscape across the asset classes, we get a sense of where interest rates and commodity prices are headed. That gives us some information on our equity investments as well. So if you are an equity-only investor, I encourage you to use your GoNoGo charts and make sure that you are tracking those other asset classes, at least in the analytics phase of your process. A lot of important information we can glean from those intermarket relationships, courtesy of John Murphy and many others. All right, let's get back over to equities. Let's take a look at the S&P 500 sector RelMap. Obviously, I'm not telling anybody anything they don't know. The world's largest company, NVIDIA, joining the Trillion Club. And when we look at the sectors of the stock market, one of the things that a lot of our peer group have been commenting on is the narrowness of the leadership. So they're talking about market breadth. How many of the issues within the index are participating to the upside? And the narrowing of the leadership groups is one of the threats most widely cited when folks are looking at potential exhaustion of this bull market trend. So Alex, talk us through what we're seeing on a GoNoGo relative strength heat map here on screen.
Yeah, and like we mentioned earlier on, as trend followers, you don't want to get out of a go trend in equities because people are concerned that it might turn around, right? Like you said, is when you're in the trend, you're in the trend, and one of the hardest things to do, but one of the best things you can do is stay with the trend. But this is why people are worried. When you look at this kind of analysis, and when we look at our GoNoGo RelMap here, you can see that there is only technology that is outperforming the larger index at the moment. All of the other sectors are relatively underperforming, and that doesn't necessarily mean they aren't in go trends on a pure basis, but there is only one sector that is relatively outperforming the benchmark index, and that's the technology sector, because of those giant stocks that you're talking about, NVIDIA, Apple, and others. So this is where that sort of idea of thin leadership comes from. This is why people think that perhaps this can't be sustained. And we'll take a look at some of these sectors as we go through the show.
Alex, I really date myself when I'm talking to university students about the CFT program and trying to share just a few concepts from the technical discipline. When I talk about relative strength, I refer to the 1990s Chicago Bulls. And of course, everybody loved Michael Jordan. We all wore his jersey and tried to save up our money to afford his shoes. But that team was incredible. They had a deep bench strength. They had Scottie Pippen, Dennis Rodman, and everybody had a job to do, and they all were the best in the league, best at their jobs. So when we're looking at the stock market, when we're measuring breadth, we want to know how many companies, how many shares are participating in an uptrend. That's the expansion of breadth. And when breadth narrows or contracts, that can give us a sign of the fragility of the upward bull trend. So we're looking at these on a relative strength basis, relative performance of the sectors relative to the benchmark index. Let's take a look at each sector in its absolute trend performance and where that price action is taking us at the sector level. So we'll go back to a GoNoGo chart. Let's just take them down the list. Let's start with the XLK that is leading the market higher.
Yeah, XLK, you can see, has really climbed above this area of congestion, found support, that again, the concept of polarity, and now it's raced higher. So this is the golden child, and of course we're making these fast higher highs for the technology sector.
When I talk to a lot of portfolio managers who made it through the end of the 1990s and the tech bubble, they were certainly happy to participate in high momentum names at the time, delivering alpha for their clients and managing concentrated portfolios. But even then, they knew that party wasn't going to last forever. And so the idea of scenario analysis or considering keeping an open mind to the fact that trend conditions can change is important. Let's move on. Let's do the consumer discretionary. The XLY is the ETF proxy we use for the consumer discretionary sector. And that's a choppy mess.
Yeah, this is a pretty ugly chart, and you can see that we haven't managed to make new highs, right? We're talking about, consecutive or continued all-time highs in the equity markets. Well, not here. We have not got higher than the prior highs that you see on this chart. And we've struggled to hold trend throughout this period. So at the moment, we are in a go trend. Momentum is positive and not yet overbought, so perhaps a little bit of room to run, but it would be nice to see the discretionary sector make new highs.
Mm-hmm. Let's move on to the communications sector, the XLC.
Yeah, XLC is looking good. Again, this is why, when people say there's very thin leadership, you want to make sure you remind yourself that these could still be in go trends, even if they aren't in relative outperformance trends to the S&P. So, nothing wrong here when you're looking at communications. We had that dip back in April that we saw in the equity markets, and we've since made higher highs. Right now, we're in a period of weakness, consolidating, and the oscillator is riding the zero line. But that's an okay looking chart for the communication sector.
And at a bit of a decision point, right? When you see that consolidation after gains, it can be a trend continuation pattern, or it can be a trend reversal pattern. And the signal for us using GoNoGo charts is going to come from momentum. So we see the oscillator riding the zero line, building up a squeeze. It's the direction of the break of momentum that would give us our leading indicator of where price action may be headed next. So
especially when we have such clear areas, as you can see on the chart here, of, again, that concept of polarity. There may well be some support, continued support, going forward at these levels as we consolidate.
Absolutely. Let's take a look at the energy sector, the XLE.
So energy, totally different. Energy in a no-go trend has been stepping down, making a series of lower lows and lower highs. You can see the oscillator really as clean as you'd like. Once it failed to find support at zero, been finding resistance at that level now several times. You saw that period of choppiness while the oscillator rode the zero line. We saw a max go-no-go squeeze build. Once that was broken, the no-go really took hold, and we've had, again, multiple times we've tested the zero level and been rejected by it. So we'll see what happens as we get close to that level again. Strong bar today, but in the context of lower lows and lower highs.
It's funny to see that price action and think about how large institutional managers exit positions. So first thing that happens, we hit the ultimate top, market corrects sharply. That puts these securities on their radar. But of course, if they're experienced money managers, they're going to wait for a bit of a retest and wait for price to pull back higher before a plunge. And so when you see that no-go trend take hold after a retest or a relief rally, it's the time that it takes for institutional pools of capital to actually exit positions. It's amazing to see that price behavior showing up right on the chart in a fair and orderly downtrend for energy.
Yep.
Let's take a look at the financial sector, the XLF.
Yeah, financial is another one that's sort of trying to make up its mind. You can see we hit highs here. We struggled. We entered into this no-go correction that had a lot of uncertainty built into it, though. When you see these consecutive amber bars in the middle of this no-go, then nobody's completely convinced of that no-go either. And then, of course, we rode the zero line, max go-no-go squeeze, broke into the upside. Go trend came back, and we made slightly higher highs. And then we would have done what we were talking about with communications. As we pull back, watch the zero line. But it didn't hold. And so now we know that this go trend is in trouble. Oscillator tested again and then back into a no-go. So very uncertain at the moment for financials. Right now we are in an amber bar again, and the oscillator is at zero.
Absolutely. Let's take a look at industrials, the XLI.
Industrials, similar, to be honest. Those industrious financial professionals, maybe, but yeah, definitely the same sort of thing we're seeing here. Lots of uncertainty sprinkled in, which if you read that as unhealthy no-go corrections, that's perhaps a good sign if you're bullish. So we've had strong go trends, very much uncertainty when we're within these no-goes. Same thing here, lots of uncertainty, oscillator at zero, really struggling to make any headway lower. So we'll just have to watch and see which one this resolves.
Absolutely. And we saw industrials as one of the most consistent outperforming groups through the end of 23 and into 2024. Let's move on. Materials, the XLB.
Yeah, materials similar in after a fashion with the industrials, sort of same kind of picture. We've had that initial correction that didn't last, and then an attempt to go back to a go trend. No higher high though, so that was telling. And then of course lots of uncertainty as we roll over, and now we're in a no-go trend. But again, oscillator at zero, and we haven't really made a significant lower low. So sort of a lot of these charts starting to tell you in no uncertain terms that the market is unsure at the moment.
Yep. Let's take a look at healthcare, XLV. One of the greatest areas for investment over the pandemic.
Yeah. Yeah, I mean, a lot of these sectors really struggling to make higher highs and trying to make those all-time highs, but haven't really been able to do it yet. Just a few of them. Healthcare looks a little bit better. We're in a go trend. We're above the zero line and testing it from above instead of from below. So the weight of the evidence for healthcare says we're in a go trend, and any kind of bounce off zero here would give us signs of trend continuation, and that might give price the push it needs to try to make a new higher high.
Absolutely. Let's take a look at consumer staples, the XLP.
So staples has been one, we had that strange period where we were talking about how the leadership was coming from growth and defense at the same time. We had that period where staples was in a relative go trend, and so was technology. And you can see why that was. Until recently, we were sort of making, these higher highs on staples as well. And that's cooled off a little bit, but definitely we are above an area that could provide support going forward. There's that concept of polarity again. We are in a go trend, painting strong blue bars, and the oscillator's at zero. So staples look stronger than a lot of them.
Absolutely. And utilities, the XLU.
Utilities has fallen out of its go trend, obviously one of the other defensive sectors, and we sort of saw perhaps a leading indication that might happen when the oscillator failed to hold the zero line here, as we saw this sort of top of the go trend momentum went in the wrong direction. So now we've got negative momentum confirming the underlying no-go trend that we've now entered into. So a little bit more bearish here for utilities.
Absolutely. Thank you, Alex, for that review on the sectors, and I think for all of our GoNoGo viewers, getting a sense of keeping an open mind, right? Opinions strongly held, or excuse me, strong opinions loosely held, that we could be prepared if the market indeed changes or enters a different kind of regime of higher volatility, perhaps deeper corrective phases throughout summer months. But the important message for all of us is that we have to stick to our discipline and our process. And final note on that, only you can decide what your time frame is. So if you're executing based on daily closing prices and the information that that you're gleaning on the daily basis, or maybe you're even longer term and it's the weekly chart that you execute on, that's just fine. I would encourage everybody not to change their stripes as the market conditions change, or because you've heard something on the news that got you scared. Those are behavioral impulses, and what we want to maintain is an objective view of what's currently happening and react responsibly to that. So hopefully this was a helpful exercise for you today on the GoNoGo Show. Alex and I have some very exciting news for all of you. If you are a stock charts user, you have through the end of June to enable that plugin for your charts. So you can have GoNoGo Charts for a lifetime. We're going to be changing the model there to be in line with all of the other great platforms that we are on, like TrendSpider, Ninja Trade Ideas, Optima, and many others. The list goes on quite a ways. But if you've been watching this and you're a stock charts user, that is going to change July 1st to a subscription-based model, and we'll send you more information about that. If you have any questions, you can reach out to us, info@GoNoGoCharts.com. We also are going to be releasing a new product. So all of those heat maps and the relative strength work that we've done with our institutional clients, we're going to be bringing that to several of these platforms here in the back half of 2024. So really excited for new implementation, new set of tools for all of you to use. And as always, we appreciate you tuning into this show. Feel free to subscribe to this channel, share it with your colleagues, clients, and friends, and we will be back again next week. Until then, take care of each other and trade them well.